The clock is ticking. Get ready for a massive economic correction. Hey, everybody, my name is JJ. You're watching Bull Boom Bear Bust, back with another dose of economic reality. We've got some charts here that are going to, I think, blow your mind on how big of a bubble we're in uncharted territory, worse than the financial crisis, way worse than some other time periods. We're going to talk about that here in just a few minutes. But first of all, this week has been very optimistic for the outlook for the near term and the long term economy in the eyes of some because of this retail spending. Well, we talked about this the last couple of videos. We talked about the Black Friday numbers. And here's something else I need to add to the conversation we've been having about this. Is the consumer still spending a lot of money? Yes. But here's the thing. The stores were very, very empty. We showed you videos here on this channel, our previous video, other channels also highlighting how empty the stores were. Here's what retailers are doing. A lot of them are not offering very good sales in store, so they don't have to pay as much staff. They don't have to pay as much staff to be in the stores, and they're offering the best deals online, and that saves them a lot of money. You don't have to pay the people hourly to be in the store. You're still open, and you're still paying some people, but not like if it was super sale Black Friday where you have mobs outside the door and everything's, half off or whatever, big screen TVs for 90 bucks. You don't see that. If you did see that, you'd have to have a lot more staff at these stores, and that's just a bigger part of the cost cutting that retailers are having to do, especially with the increase in the theft and everything else, just the expenses and the high cost, the high wages, right? So higher wages means businesses are going to look to not have as many people working. It's pretty simple. More AI, more robots. When you call a place, you're going to get one of those automated menus. You have to listen to 9 options before you find the one that's right, and it still might not be the right one. You have to hit 0. They're going to be replacing people any way they can. And online shopping and doing the best sales online, that's a real simple way for retailers to do that. So the Black Friday numbers, yes, stores were empty. A lot of stores were very empty. Some stores not so much. But compared to previous years, the Walmarts, we didn't see the stampedes. We saw some empty Targets and empty Walmarts, empty retailers. It was very strange to some people, but when you connect the dots, it's not that strange to see what's going on. Consumers are really, really deep in debt, not tapped out or maxed out yet, because credit card limits remain high. They're not cutting the limits, and not only that, they're still increasing limits. When you look at the available credit available to U.S. consumers, credit card companies are still increasing these ceilings almost as if nothing is going wrong, but defaults are starting to increase. We see in the car market also, car loans, the delinquencies are the worst in history, and a chart we have coming up here in just a minute is going to show you how bad affordability is in the housing market, folks. This bubble is massive, and yes, there will be a correction. There will be a piper to pay. Some people think that if they just cancel foreclosures and cancel evictions, that we'll never see a correction. But think about it. What happens if they do those things again like they did in 2020? You're going to see inflation skyrocket, right? When people can't get kicked out of their homes, they stop paying. And what happens when they stop paying? Massive inflation, because the landlords that are getting rent from people, they have to raise their rent to make up for all the people that are not paying. So it's going to be a disaster either way, either an inflationary or a deflationary economic correction / maybe even a collapse. We need to start using the word collapse here. Let's go ahead and bring up a chart here and see what we've got here. First, a quick word from our sponsor. We'll be right back on the other side. It's about 1 minute, and you're not going to believe this chart. Stick around. 1 minute. We'll be right back. Dark clouds are gathering as markets shudder. Stocks are sinking, currencies stumbling. Fear and uncertainty reign. The Middle East, Ukraine, Taiwan, the debt. It's endless. Yet one asset stands firm. Gold. In crisis after crisis, gold is there in the background. Its enduring value guards against loss like a missile shield against incoming. While paper wealth burns, gold persists. Shield your savings against looming threats, war, recession, contagion, and avoid the frenzied panic of the unprepared. Take control in the chaos. Fortune favors decisive action. Get hold of gold now before it's out of reach. Right now, Noble Gold Investments offers a free 5-ounce America the Beautiful coin with every new IRA. Claim your free coin today to secure your financial future. as this new storm gathers, panic looms. And some of the places you were thinking for your money, well, they don't look so clever anymore. Secure your future against disaster. Open a Noble Gold Investments IRA and claim your free bullion coin today. Go to noblegoldinvestments.com now. Noblegoldinvestments.com, the only company I trust. Link down in the description of this video. All right, people, take a look at this. This is the least affordable housing market since the 1980s, the early 1980s. We're talking 40 years ago. Let me go ahead and enlarge this because this is a whopper of a chart here that really paints the picture on what's going on here. Percentage of median income needed to pay mortgages. We are at 40.5%. That's the percentage of the median income needed to pay the mortgage on a new house. Lower than 1984. Remember, the 80s had a big spike in interest rates for a bit there, up over 18%. So that was the maximum unaffordability. But if you look to the right here, home price to income ratio, we're way beyond the 80s. We're way beyond the financial crisis. And look to the right end of this chart here, and you see where we're at. And it looks like a topping pattern. A topping pattern means you see a spike, a drop, and another spike up that didn't pass the previous spike. If you look at the mouse where I'm at here, that's looking to be a topping pattern. And those happen near or at the peak, meaning the collapse or correction could be a very short time away. It could be weeks, could be months, but I couldn't see us lasting more than a year in this uncharted, economic bubble / cost of living monster territory that we're in right now. It's not sustainable. The consumers don't have enough firing power to keep this thing going here. And this article here out of CNN actually goes into the numbers pretty well. Inflation has impacted spending on major purchases. Balance on non-housing loans have more than doubled since 2003, totaling roughly $4.8 trillion, according to data from the New York Fed. More than $500 billion of that debt accumulated just in the past 2 years, a bigger jump than any other 2-year period in about 20 years. Some of that debt comes from skyrocketing car prices, credit card balances, of course, all the stuff we know, but it is nice to see it pointed out in some of these news media outlets here. So here's what a lot of people will say. They'll say, JJ, we know this. We know what's happening. We know we're headed for a collapse. We know the consumer's almost tapped out. We don't have much longer. What can we do to take advantage of this? Here's what I'm doing. I'm shorting retail, and I'm shorting a retail ETF. You can go to an inverse ETF, which you make money if retail stocks go down. It's an inverse ETF. Or you can short the bullish ETF, which if retail does good, they're going to go up. But if you short that, you're going to make money shorting it. So I happen to be shorting the bullish ETF and a retail ETF. Just type it in. You'll find, I think, a few different retail ETFs. Doesn't matter which one. That's what I'm doing. So people often ask, okay, what can we do? What are the solutions? Here's what you do. You see what's going on. Retailers are very bullish for no reason because people had credit to use. That's the reason why people are bullish on retail stocks, right? So to me, that is a sell signal, and I'm going to be shorting into this, what I think is going to be a very short-lived retail rally. And retailers like Target, Walmart, a lot of them just have downside, in my opinion. Some people say Walmart's recession-proof. I don't think so. Not the way the U.S. consumer is piled under debt right now. I don't think Walmart's going to see much more upside. I could be wrong. Don't follow my trades. Do your own research. Do your own due diligence. But people do ask for solutions and what can we do to take advantage of this. That's what I'm doing. And I've been pretty lucky in the stock market before. A lot of you have followed some of my other trades and have done very well. And that's because I don't trade that much. I wait for what I think is a good setup, a good opportunity. And I think this retail false optimism right now, or false bullishness or incorrect bullishness, I think that's a great opportunity right now to be shorting retail. All right, so I'll let you know how that goes here down in a few weeks, few months. We'll keep you updated on that trade. And let's talk about what Wolf Street's talking about here. Prices of new homes dropped, and by quite a lot, 18% year over year. Of course, inventories are rising. We saw this in the previous housing bubble where new homes came down first because they're more pricey. It's interesting though that we haven't seen previously owned homes come down as much yet. It's taken a while. This pumped up economy, pumped up on easy money and a decade of low interest rates, is taking much longer to reverse. Banks are still giving out credit, so this could be a little while. You know, how much longer can banks keep issuing credit when the delinquencies and the late payments for car loans, mortgages, credit cards keep getting higher and higher each month? How much longer until we see banks really tighten up with the credit? And when that happens, that's going to trigger the real noticeable decline, because deflation will soon follow. And where there's deflation, there's more panic, more layoffs, and then it just snowballs from there. It escalates from there. And that's when you're going to see that this collapse, downturn, correction, whatever word you want to call it, that's when you're going to see this really pick up pace, right? So we're going to be at top of it here, folks. Please give us a like and subscribe if you like what we talk about here. And as always, we'll be back with more economic news and the latest updates. I'll always be right here for you. Thanks, everybody, for being here. We'll talk to you very soon. Big love. Keep stacking. Bye for now. Peace.